Before today's markets close, you'll learn the trends that experts say could change everything.
That's right. We've compiled expert opinions from financial giants like David Lin and Cathie Wood to unravel what's truly at stake.
In just minutes, you'll grasp insights on potential market crashes and bullish opportunities ahead.
Imagine spotting the next big opportunity before it gains traction. Our advanced AI summaries have made it possible.
But first, let's dive into David Lin's take on why the market may be heading for a bear crash.
And don't miss Cathie Wood's predictions about the implications of high-tech innovation amidst economic uncertainty.
A quick reminder, this content is for educational purposes and not investment advice.
Stay tuned. After these insights, we'll explore what skyrocketing interest rates mean for your portfolio.
With interest rates skyrocketing, okay, maybe not at the front end yet, but we're feeling it at the long end through the 10-year Treasury. This could change everything from your mortgage rates to global markets.
It's crucial to think through what the bond market is telling us about the economy right now. And yes, it has implications that can be surprising.
But if the yields are climbing, shouldn't we brace for a downturn? I mean, higher rates generally mean trouble, right?
Not necessarily. Hold that thought. Let's explore this concept of yield curves and what they really mean.
To put it simply, when we see rising treasuries, it can tell us a lot about inflation and economic growth expectations.
Exactly. Think of it like the temperature gauge for the economy. Too high can mean a fever, but just getting a little warmth can signal recovery.
But why does it feel so counterintuitive? Higher rates tend to scare investors, right?
We've seen the 10-year Treasury yield jump from about 4.15% to 4.4%. That's significant. It impacts everything from student loans to mortgages.
Isn't that going to crush the housing market, though? I mean, people want lower rates.
But George actually brings up a great point. Rising rates often signal an improving economy, which can support the housing market despite the higher rates. Rising Treasury yields can often indicate that investors believe economic growth is around the corner. Remember the narrative during economic recovery phases.
Absolutely. Think of the economy as a plant. It needs sunlight or growth to flourish, even if sometimes you have to deal with weeds, like inflation.
So, are you saying a high yield isn't the doom I thought it was? That's a game changer from my perspective.
Let's not forget the past. When the Fed cut rates in 2007, we saw a similar trend. Yields jittered but held firm.
Right, it's like deja vu. Spiraling yields can come as a signal for growth, even amidst turmoil.
I get that now. It's all about the broader story behind the numbers.
If we see this bear steepening continue, we might have to reevaluate how we handle our financial strategies.
It's crucial to stay adaptable. What worked in the past may not hold true this time around.
Got it. So it's time to keep a close eye on those trends and adjust as needed.
New home buyers need to prepare for higher mortgage rates, but also understand that robust economic conditions can still favor housing.
And investors should consider diversifying, as these currents can reshape opportunities.
Man, it's like trying to ride a wave. Know when to paddle hard and when to ride it out.
The bottom line, the real story lies beyond the rates. It's about how those rates reflect our economic journey.
Exactly. It's crucial to understand when to be reactive versus proactive in your financial planning.
I never thought I'd be this excited about interest rates, but now I feel like I can really take control.
Next, we're diving into the tangible impacts of inflation, what it means for your everyday expenses and financial well-being.
Stick around. We'll explore how economic shifts directly influence your wallet.
You won't want to miss this. I'm ready to be a savvy shopper.
Last week, the Treasury market stirred quite a buzz. Is the calm before the storm, or are we seeing signs of a brewing financial crisis?
Absolutely. The surge in demand for Treasury bills has raised eyebrows, indicating that market participants might be bracing for something bigger.
And wait, didn't someone once say Treasury bills are about as exciting as watching paint dry? What's changed?
Consider this. We're in a world where the mundane is actually the harbinger of storms. Let's look closer.
We've seen Treasury yields plummet as demand skyrockets, meaning investors are flocking to safety amid uncertainty.
So a low yield is bad for borrowers, but good for investors? That's counterintuitive.
It's all about perception. In times of uncertainty, investors prioritize safety which explains the surge in treasuries. So we had a bid to cover of 3.14 last week, up from 2.73 despite less being offered. That's a huge shift.
Right, and that indicates a heightened panic. Investors are seeking safety in bills even when fewer are available.
Sounds like a game of musical chairs in a crisis.
Exactly, and this tension perfectly showcases market anxiety.
Collateral is crucial. In a way, it's the lifeblood of the market. Without sufficient flow, everything starts to choke.
So it's less about cash flow and more about the right kind of collateral flowing.
Precisely. It's like having a well-oiled machine. Without the right parts, it simply doesn't run. As we move forward, expect volatility. If supply chaos continues, markets may react sharply.
Right. Investors should prepare for fluctuations, and mindfulness of Treasury signals will be crucial.
So basically, arm yourself with knowledge and maybe some popcorn?
Definitely. The next few months are about to be a wild ride.
Keeping an eye on the Treasury market helps mitigate risks effectively.
Absolutely. It's like safeguarding an umbrella before the rain starts.
So I guess it's all about being prepared for whatever storm heads our way.
Exactly. The best defense is a good defense in financial markets. We're in for quite a ride, and our resident expert Felix Zulauf thinks the top could be near.
Absolutely, David. We're looking at a potential decline of 15 to 20% for the S&P 500, and it's going to be a rocky year.
Wait, so you're saying we could be facing a real major sell-off soon? That's alarming.
Alarming, yes, but it's crucial we prepare for what's ahead.
This isn't just upheaval driven by emotions. It's built on real cycles of history where markets don't correct sideways.
But how should someone like me, not an economics whiz, make sense of all this chaos?
By realizing that history shows us high valuations lead to low future returns. It's a roller coaster, not a merry-go-round.
The so-called Trump bubble has hyper-accelerated market inflation through excessive liquidity.
So this isn't just a phase, it's a warning bell. How do proactive investors guard against this?
What do we do? Sell everything? That feels extreme.
Not sell all. It's about strategy, knowing when to navigate out before a train wreck happens. If these tariffs are enacted, consumers will either face higher prices or producers will earn less. It's a major tax.
So you're saying tariffs feel like a tax on our everyday shopping? That's tough to swallow.
It is, but understanding this connection empowers us to make informed decisions.
The market is a reflection of investor sentiment, sometimes more than fundamentals. What goes up can crash down.
Right, so it's about staying calm amid chaos. How do we maintain our composure?
Do we need to meditate on these charts or what?
Just recall the historical patterns. They're guidelines, not guarantees.
Felix sees early 2025 as rocky, but believes if support comes in, we could rebound higher. Is that a realistic optimism?
I think so. If we can navigate through uncertainties smoothly, it's a strong case for recovery. Just prepare for turbulence.
Turbulence and recovery sound like a roller coaster. I'm not sure I'm ready for that ride.
In a market filled with highs and lows, watch for signs, pay attention to valuations. They carry weight.
So like preparing for a storm, staying informed and adaptive is key, right?
I'm definitely noting to keep my eye on those market waves.
Is the Santa Claus rally canceled this year? It certainly looks like it, especially with Nvidia threatening a major breakdown.
Right, the market breadth is concerning. Not to mention rising interest rates putting further pressure on investors.
So you're saying Santa might take the year off because of Nvidia? That's quite a scenario.
Nvidia, often dubbed as the one stock to rule them all, is now a shadow over the Santa rally.
Absolutely. With market breadth looking horrific, it's time for traders to reconsider their positions.
I guess when the one stock falters, that's a cue for everyone to think twice.
The breadth of the market looks horrific, with net flows showing a decline.
Exactly. Negative flows signal profit-taking rather than aggressive buying.
So, is this running on fumes for the market?
If this trend continues, we could see increased volatility as we approach year-end.
Indeed, all eyes will be on Nvidia to gauge the market's next move.
So should we brace ourselves for a potential market shakeup?
Investors should remain vigilant. Nvidia's fate could determine the market's holiday cheer.
Agreed. Understanding these market dynamics will be crucial in navigating the upcoming weeks.
So it's not just Santa who might need a new strategy, it's every investor out there.
Exciting times here at ARK Invest. Today we're diving into Tesla's latest move with FSD V13. Tasha, take it away.
Absolutely. This version marks a major leap. You can now start from park, shift gears, and park at your destination, all without needing to touch the steering wheel.
Wait, you mean it can actually operate itself all the way from start to finish? That's amazing.
This isn't just about making life easier. It's about laying the foundation for a larger shift to autonomy and all that entails.
Isn't there a catch, though? What are the skeptics saying about this bold claim?
Great point. It's crucial to address those doubts head-on, especially when talking about safety and reliability. Tasha, we've heard mixed reviews about the latest updates from users. How are they reacting?
While there's excitement, skepticism looms. Users still need to take control under certain conditions, leading to questions about the system's current efficacy.
So it's like a teenager trying to drive. Still needs a little supervision.
Charging still presents hurdles, but wireless charging could change everything. Imagine a taxi that simply pulls into a space and charges without a plug.
Sounds convenient, but will that be ready in time?
I can see some tech-savvy folks pulling that off. But will the rest of us be stuck plugging in our cars?
What are the implications for car ownership, do you think?
Ownership may shift as more users opt into fleets, especially as younger generations show less interest in owning cars.
So, we might soon treat our Teslas like Uber rides. That's a wild thought.
Going head-to-head with companies like Uber will be challenging, but Tesla's model offers unique advantages.
They can drive the costs down due to lower operating expenses, right?
Yes, lower costs could make the service more attractive, especially for consumers used to ride-hailing. We're looking at an exciting roadmap leading to a full launch, possibly by 2025.
With existing infrastructure and early public adoption, this could really take off.
So, it's the dawn of the robo-taxi era? That's something to watch.
To sum it up, we're seeing a transformative phase in how we think about transportation and ownership.
Indeed, this isn't just innovation, it's a cultural shift.
Kind of like going from dial-up to broadband.
As the calendar year approaches its end, we're witnessing some fascinating movements in the market. Today, I have Lance Roberts with me to dissect what it all means.
Absolutely, Adam. December is notoriously choppy, leaving many investors wondering if this year we'll see the classic Santa Claus rally.
For those who may not know, can you explain what the Santa Claus rally is?
Sure. It's that phenomenon where stocks often rise in the last week of December and the first few sessions of January. They're often influenced by seasonal trading patterns.
You've been detailing how this December might unfold, pointing to mutual fund distributions as a key influence.
That's right. Mutual funds have to distribute gains before year-end, which typically leads to sell-offs and then subsequent buy-ins.
Is that why we're seeing some of the big names surge recently?
Exactly. Portfolio managers are looking to rebalance, often leading to volatility.
So how should investors be responding to these distribution pressures?
Be proactive. Look to add to positions that show strength in a rally. It's crucial to be strategic.
But with the recent choppiness, how do we know when to jump in?
Use support levels as guidelines. A pullback to the 20-day moving average could signal a solid entry point. I think the markets will see some buying pressure as we close in on year-end, but be prepared for potential pullbacks.
What are the signs we should be looking for?
Watch for volatility spikes. If the market holds its support levels through December, we may see that rally materialize.
We've covered a lot of ground today. The key is to stay flexible as the market evolves.
Exactly. Prepare for potential shifts and don't hesitate to capitalize on opportunities.
So it sounds like next week is crucial. Time to strategize.
What an incredible lineup of guests we had today.
Absolutely. Each expert brought unique insights to the table.
Lance emphasized the need to adapt our investments based on market cycles, right?
Exactly. But then Tasha shifted the focus to Tesla's fascinating journey towards autonomy.
And Matt painted a rather grim picture with Nvidia's performance affecting the Santa Claus rally.
True. Plus Felix's warning about a market correction and George's insights on interest rates add layers to this discussion.
It's clear that while they agree on the necessity for adaptability, they differ greatly on the timing of these changes.
And their views on the impact of tech versus traditional investments are definitely divergent.
This complexity keeps us on our toes as investors.
For sure. So if you enjoyed these valuable insights, give us a thumbs up and hit that subscribe button.
Your likes and subscriptions help us bring you even more expert discussions in the future.
Thank you for tuning in. Don't forget to check out our other videos for ongoing financial wisdom.